Mark was saying, interesting day, Capital Judo Bank, the small business bank. Its shares are eyeing the best day ever today after the company posted a 24% jump in first half net profit before tax to $67 million. Looking ahead, company has provided guidance forecasting full year profit before tax between 107 and 112 million, targeting profit growth 15% FY25, expects profit in the second half of the year to be in the range of 40 to 45 million. Results will be released to the market February 20. Mark Gardner, this has been a really good update from Judo. Took the market a bit by surprise.
It did. It got a downgrade, yes, on the 21st, I believe, which was, we were just discussing before we went on air, pretty bold move, and to be completely wrong as well. This is it's a pretty simple business model. They basically got a banking license during the Royal Commission because the Big Four didn't want to service the small medium enterprises, and essentially it's run by a bunch of guys who essentially got backgrounds from the Big Four in this, in that sort of enterprise. So obviously it was only listed sort of back late 2022. Everything on their prospectus, every target they've set so far in all their AGMs, etc., they're pretty much 100%, if not 100%. They've got, their CET1 ratio is the highest of any bank in Australia. 16. It's dropped a little bit, but it's 16.2 still. But you would expect them to hold higher capital margin, obviously, because they're slightly riskier loans. But their credit quality is very good. And their net interest margin 3.02. I think they borrowed some money coming out of COVID from the RBA, TFF, and essentially they've got to pay that back by the end of this financial year. But that's going to bring their NIM down to 2.9. But I think that a lot of analysts thought the NIM would get savaged a lot harder than that. Yep. So at 2.9, I mean, two of the Big Four are nowhere near. They're less than half of that overall. So
and their founders, ex-NAB, I think they were for years and years really experienced founders. I caught up with them end of last year. They were really annoyed, and quite rightly by the look of this update. Saying the market just didn't understand their business that well and wouldn't even come and talk to them about the metrics, which was reflected in a downgrade 2 days before a great update.
Which was again completely wrong. And look, they've beaten. They've gone and sourced APRA numbers and things, which were obviously from the part too far back, because that wasn't the case here. They actually beat those. They beat those numbers as well. So we got them in our balanced and our alpha portfolio as well. Right. We bought 84s recently which is more of our short-term recommendation service. But in our balanced portfolio, this is the sort of thing we'll just basically add to it over time. We've only got about 1.5% in there at the moment.
So $1.09, it's coming off its lows. Today it's had a bit of a pop-up. Would you be buying at $1.09?
But just with the view that it's probably a long-term play, but they seem to consistently deliver. And I think, on a 3 to 5 year basis, this could be the sort of thing that's at $4 or $5 potentially, because they're growing at a really nice rate. They're very, very disciplined with their capital, and all they've got to do is take a small bite out of the Big Four.
So the big banks are under pressure at the moment. The fintechs are under pressure. Is this the standout for you in the banking sector?
Yeah, but be conscious of allocation size though. I mean, it's still an early stage business. I don't think you're throwing the kitchen sink at it. No. It's not like a CBA or Macquarie, for instance, but it's just definitely one that I think will that'll tick away very nicely. I mean, even their AGM and their investor presentations, it's like they've hired the same graphic designer as CBA. It's almost bang on. So I think that's probably a reflection of what their vision is to be, and start taking a bite out of the big boys.
Mark, haven't been listed long enough for
investors. It's only got 2 years. The story is that they've got quite a good story. I'd be a bit more wary of the niche they're in. Now, they've got a nice niche with the small, medium businesses, because Mark is right, the big banks basically don't want to lend to them. The big banks are building societies. They want to let on residential mortgages is really all they want to do. But anyway, so there's a nice market there, but it also has potentially bigger credit risks over time. And that's the thing you've got to watch, because their net interest margin, the NIM, I was talking about, is very good at the moment. That can get savage very quickly if your loan book deteriorates.
Sure.
So you've got to look at the cycle, where we're at.
But it's way above any other bank, isn't
That's
it?
right.
Sort
Yeah,
of
well, that's good,
triple
but
any
we
other
don't
bank.
generally like the banks anyway at the moment. So that all looks good. Just from the preliminary numbers that I can see, return on equity is only 5.1 though. And we have a minimum of 10.
Yeah.
CBA is on. I'm not sure what CBA is now. Be around that probably, wouldn't it? Maybe anyway.
Yeah, I think it's about 11 or 12.
Yeah, it's still a little bit above that. So it wouldn't meet our basic numbers anyway yet, but we need another 3 or 4 years. But it looks encouraging,
Right?
And if they can manage the loan book and maintain high collection rates and so on, then they'll do well.
Okay.